But before I delve too deeply into that, which is going to be exciting, let's take a step back and review 2012. Going into 2012, we stood here last year and said, we think this year we will resolve our mid-cycle crisis, okay? So we expected that perhaps the economy would slow and that politicians might be, somewhat difficult to sustain. But nonetheless, we expected that confidence would build throughout the year and that indeed would resolve what we termed the mid-cycle crisis. Last year was actually a pretty good year. We didn't have a major crisis. This is a chart of the VIX index, which is a measure of volatility in the marketplace. Some term it the fear index. And as you can see, back in 2008, we had an event. That was difficult in the market. The VIX spiked higher. And then in 2009, we sort of gathered our wits about us. Going into 2010, we had an echo crisis, the European financial crisis. 2011, we manufactured our own fiscal crisis here in the United States of America. But notice that in 2012, we really didn't have a crisis. It was the first time in years that the VIX didn't spike above 30. And so that benign backdrop really led to a steady climb in confidence throughout the year. And so the combination of that benign backdrop and a rise in confidence really did allow us to resolve what I term the mid-cycle crisis. So let's see how we did on our predictions. Remember, as I'm fond of saying, we're transparent. We were transparent before transparent was cool. And so we'll go back and grade ourselves on the stuff we said was going to happen every year, whether we're right or wrong. We're wrong some, but we're right more than we're wrong. So in terms of equities, we expected stock prices to go higher. We also expected that would really be a result of multiple expansion. We expected the economy to be slow. We expected earnings growth to be slow, but we expect confidence to rise and push multiples higher. So indeed, the stock market did go up last year. A lot of those gains were in the first quarter. And so you can see we got 13% or so in the first quarter. We trailed down a little bit in the second quarter as we got Euro-itis again. And then we fixed that problem and things were really steadily higher all the way to the end of the year. So it was really, kind of a low volatility, higher year. And if you look at where the growth in returns really came from, the engine of growth was multiple expansion. So we began the year at a PE of about 13. We ended the year at a PE of 14.63. Now, for those of you who've done the math, that's about a 13% expansion in the multiple. So the market did about 15% and change. So we got 13% from multiple expansion, we got 2% from dividends, and we got a measly 1% from earnings. So nonetheless, we ended up having a 15% plus year, but it did all come from multiple expansion. So we'll give ourselves a check mark on that. In terms of size, we expected, again, that a resumption of confidence would take the markets higher, and we didn't see any distinct advantage either from an earnings perspective or a valuation perspective between small companies and large companies. We expected the rising tide to kind of lift all boats. That's precisely what happened last year. And so you can see the S&P 500 is basically large cap companies, mid cap companies, small cap companies represented by the Russell 2000. Really, it was broad participation. The rising tide did lift all boats, and so we'll give ourselves a check mark on that, 2 for 2. In terms of style, we expected that as people became more confident that the correlations in the market would go down. And what I mean by that is so much of the trading activity that's occurred since 2008 has sort of been, am I in or am I out? Do I want to own stocks at all or do I want to be in cash? Well, we expected as confidence went up that people would get a little bit more granular in their decision-making process and think, well, do I want to own Coke or Pepsi? And so that's an advantage for active money managers, which we prefer, because it really becomes a stock picker's market. So this is a chart that shows you how active money managers did relative to their benchmarks last year in a couple different styles. So growth managers had a good year. 54% of active growth managers actually outperformed their indices. Value managers did not have a good year. Only 20% of value managers outperformed their indices. And so overall, only 40% of active managers outperformed their benchmarks, and therefore we'll give ourselves an X on that one. I will tell you, though, that the improvement in that trend has continued, and so far it does look like a stock picker environment in 2013, which bodes well, I hope, for our strategy. In terms of domicile, after the pessimism really inflicted pain on the international markets, we expected a return of optimism to benefit internationals more than the U.S. That was indeed the case. So U.S. market did well, as I showed you. However, the developed markets outside the U.S., and I will explain that. So that's Canada and Europe and Japan, basically. You'll see developed ex-U.S. a few times in the presentation. That's what that means. The emerging markets did even better than that. That's Brazil, Russia, India, China. And so the internationals did outperform. We're back in the positive column. In terms of U.S. interest rates, we expected that people might decide they don't want to own as many bonds as they wanted to own last year or 2011, and maybe they'd like to own stocks, and so perhaps we'd see a little bit of a rotation there. Long rates did go higher. There was actually, it's kind of interesting, we saw a surge in the beginning of the year, most of that attributed to the fact that the economy grew very quickly in the fourth quarter of 2011, and people just extrapolate that stuff forward. So rates really sold off. Then we got nervous about Europe again. Then rates started coming back once we seemed to solve that problem, and then the Fed stepped in and said, we're going to buy a whole bunch of bonds. And so they kept the interest rate complex down, but as I will tell you, the force of the market really wants to push those higher. So by the end of the year, they did creep a little bit higher, not anything to worry about. So we'll give ourselves a check mark on that. In terms of the U.S. dollar, you know, the U.S. dollar is actually seen as a safe haven currency, and so when the world gets worried, they sell their currency and they buy dollars. We expected, as optimism rebounded, that the dollar would weaken as money started looking for other return opportunities. That was indeed the case. And so this is a list of currencies. I won't go all the way through them. Here's gold for you gold bugs. Gold was up 7% last year against the dollar. This should interest you. Those of you who read Boomerang and then kept beating me on the head with it, telling me that Europe was going to go away, the euro actually appreciated 2% against the dollar last year, and it's kind of tied with the dollar so far this year. The emerging market currencies had another good year, so they were up, 3.5% or so. The only currency of meaning that depreciated against the dollar was the Bank of Japan. Most of that happened at the end of the year, or the Japanese yen, I should say, and specifically because the Bank of Japan is trying to debase that currency. We'll talk more about that later. So how did we do on that one? We did very well on that one. In terms of bonds, we expected that optimism would favor credit-sensitive bonds over the skepticism that typically favors interest rate-sensitive bonds. And so let's just look at a quick comparison. Green is what you buy if you're optimistic, which is corporate bonds. Blue is what you buy if you're pessimistic, which is U.S. Treasuries. And you can see, although we had a minor sort of convergence here in the middle of the year when we were worried about Europe again, by the end of the year, it was clear that credit risk outperformed interest rate risk. Yay, risk. All right. Lastly, I will tell you that the primary threat we saw to our forecast last year was politicians. And we talked a lot about politicians. I'm giving you all a break this year. We're not going to talk about politics this year. I just don't want to do it anymore. But in terms of the politicians, we had some big events, right? We had the fiscal cliff in the U.S. We had the 17 nations of the euro trying to get along and, a central bank trying to do its job. And then, of course, we had the political changeover in China that people weren't too comfortable with. So there were plenty of places for politicians to kind of screw things up. Fortunately, they didn't. And actually, there was one politician on the planet who was extremely helpful. This is a picture of Mario Draghi. He is the president of the European Central Bank. And while I was on summer vacation starting to sweat the down market, which seems to happen every year, I was sitting on a couch watching CNBC, and Draghi goes, you guys got to stop worrying. We're going to do whatever it takes to preserve the euro. And from that moment to the rest of the year, the market went up. And so for that reason, the coveted WNA's Man of the Year award goes to Mario Draghi. Mario could not be with us today. However, we'll mail him his trophy. We have to buy it first. All right, so I'm happy that we got the politicians' forecast wrong. So it's nice that we get an A on this report card, but the question is, how did we perform?